Good afternoon. I'm Steve Nicklin, SVP of Marketing and Analytics here at the OAAA, and I'm pleased to welcome you to today's OAAA webinar featuring the Midyear Advertising Forecast from GroupM. Before we begin, as always, just a few quick topics to review. We welcome your questions throughout the webinar. Please feel free to use the questions function in the Zoom program. If we can't get to your question, we will follow up with you individually after the webinar. As always, all of our webinar content is featured in our webinar library, which you can access from the News and Events tab on our homepage. A recording of the webinar will also be available later this afternoon. So to set the stage for today's presentation, a quick recap that out-of-home finished the first quarter of this year up almost 7%. And GroupM, along with other major forecasting entities, recently increased their overall media projections for 2024, including that for out-of-home. I do want to point out that GroupM tracks out-of-home and cinema separately, whereas OAAA reports cinema as part of out-of-home. So you'll want to keep that in mind as you view the webinar content today. Some of you already had the pleasure of seeing today's guest, Kate Scott-Dawkins, present at our spring conference. And so we're super excited to have Kate back with us today. They have recently revised last month their projections since she presented in the spring. So she's got new information hot off the press to share. We're thrilled to have her back today. Kate, welcome, and it's great to see you again. I know our members are really eager to hear the informative analysis she'll be sharing. So let's get started.
Great. Okay. I am also going to share my screen. Good to be back again already. It doesn't feel like it's been that long since San Diego, but we have released a new report in that time. So that's what we're going to walk through today. Really looking at the outlook for the future of advertising. Headline numbers, 7.8% global growth this year, up to nearly $990 billion. Surpassing $1 trillion next year, which is even earlier than we had previously forecast. The US forecast is for 5.8%. Both of those numbers, as Steve mentioned, are actually higher than where we were in December. And we will get into some of the reasons for that in the coming slides. I am going to start with really a few high-level themes that talk to the global context, right? This is a bit of the 30,000-foot view, super important. The US will feature in this. It is, a dominant player in the space, and many of the things that we talk about that exist as global themes are really, first and foremost present in the US. So it is really a global and US story. And part of that, as you'll see, is because 22 of the top 25 global ad sellers are either in the US or China. These two markets alone really do dictate, for the most part, global growth and global trends. They represent more than 57% of total advertising, just the two of them. And you can see the next closest market, Japan and the UK, is still only a quarter of the size of China, the US even larger. So these two markets really do make a big dent. They are the reason that our forecasts have jumped again from our 5.3% of last December to 7.8% now globally. And some of that, I think, again, really important just to clarify, is that we did a lot of revisions to our China forecast. And we now think that the social platforms there, Douyin, which is the sister app to TikTok owned by ByteDance, and Red or Xiaohongshu, are generating just even more revenue than we thought, and from some new sort of areas. So money coming from offline sales into these social platforms, explaining China's 14% growth number. It's not that the economy is going to grow 14% this year. The government has said they're looking at roughly 5%. Consumer spend and consumer sentiment is still very, very depressed there. And so they're really, we're looking at money coming from areas where it was already being spent, but that weren't tagged as media. now into these social platforms where we are measuring it. So it's sort of new sources of growth rather than incremental growth from the same advertisers within the same platform. So important, I think, to note there. And it is part of this overarching trend of globalization. US content and commerce companies going overseas, like Amazon and Walmart, and importantly, also European companies, but especially Chinese companies expanding into markets like the US, whether that's Temu or TikTok, or the manufacturers themselves advertising to US consumers. And so when we talk about that 5.8% growth in the US, the important thing, again, to understand there is how much of that is being driven by Chinese manufacturers looking for increased exports out of China, advertising on places like Amazon's marketplace and Walmart's marketplace. This chart is just showing the extent to which new sellers on Walmart's marketplace have exploded to include so many Chinese manufacturers and Chinese sellers versus a year ago. So again, important to contextualize when we're talking about the speed of growth and the extent of growth within the US, that some of that is coming from overseas ad sellers. Now, the sort of reaction to the tension that exists against this long-standing trend of globalization, and especially, again, globalization of the largest US companies, Google, Meta, Amazon, and the largest Chinese companies, ByteDance and Alibaba among them, is that we're seeing increased regulatory appetite for challenging these companies and for looking into data privacy practices, antitrust movements. And in that sense, it's actually kind of interesting when we're talking about this consolidation of companies that an out-of-home world, it's going a bit the other direction. So we normally think about companies expanding to new markets, buying other firms to grow their global footprint, versus where we have like out of front, moving out of the Canadian market, Clear Channel re-looking at their European markets and divesting those markets. And I think it's sort of an interesting counterpoint for out of home versus the rest of the industry, and especially the digital and the TV markets. But back to regulation, as I mentioned, these top 5 sellers, and I think some of you will have seen this slide in late April, May. There is revenue concentration at the top. So the top 5 global ad sellers grew 23% on a compound annual basis over the last 7 years. The rest of the industry grew just 2.1%. And so that is sort of the dynamic that has really increased scrutiny and increased regulation from governments looking at a lot of these top players. And that exists across, advertising companies, as it does across content and commerce companies, AI companies like OpenAI, and also platform companies like Google and Apple, with governments looking at the consolidation of power and influence within their app stores, for example. Now, even if the leaders of the regulatory bodies are not elected, the governments that appoint them are. And political is another one of our key themes for this report and this year. It was a huge year for elections. I think roughly half or more than half of the global population went to the polls, nearly 1 billion people in India alone. And so we wanted to understand the extent to which advertising plays a role in these governments, and also the extent to which political advertising impacts total advertising in those markets. Now, within the US, we've always excluded, or at least shown it separately, US political advertising from the national total because it has such a skewing impact. So political advertising in the US this year, excluding things like direct mail, it's going to be more than $15 billion. That's roughly the same size as Australia. So it's like adding the entire advertising market for Australia into the US in 1 year. It has a huge impact on the growth rates when we look at, this year versus next year, and or this year versus last year, and next year versus this year. Now, the total sort of absolute dollar figures for the rest of the world are actually quite small. But I think interesting to note how what percentage political advertising does play in these other markets, and whether they will continue to go sort of along the same path that the US has, which is greater tolerance for campaign fundraising, greater tolerance for campaign spending, and where that is likely to go. Now, the biggest beneficiaries in the US are certainly local cable, local broadcast. We're seeing more and more push into CTV. And also I think there's been interesting talks with Steve in San Diego around the greater proportion of out-of-home use cases and political types where not just local campaigns, but actually more statewide. So I think interesting point of opportunity as campaigns look beyond sort of television and cable television, linear and cable television with cord cutting. They're going to be looking for other broad reach vehicles for their advertising and political advertising. Now, one of the largest complaints, I think, about politics is its increasing polarization over the last several years. And I'd say that's, also a point of, a result of the other long-term trend that we talk about in the report, which is decentralization. So we talked about globalization and consolidation, more revenue concentration among the top media sellers, commerce and content companies expanding internationally. And somewhat contradictorily, we are also looking at decentralization at the same time. So I'll give you a couple of examples of this. We'll look at content and content production first. So historically, this would have been done in a very centralized way. You would have had the largest studios making video content. You would have had the newspapers making news content. And content moderation would have also been done within those same centralized organizations, with editorial rooms and editorial teams moderating content within those central organizations. What we have now is a very decentralized space, or increasingly decentralized, where individual content creators on these platforms like Instagram and TikTok are all creating content. And no one is necessarily, speaking to the same things. And content moderation, similarly, if we look at X with community notes or Reddit with moderators, the decentralization work has also been pushed out to individuals instead of happening at the center. And that happens just the same on the content consumption side. So whereas before we would have all sat down to watch that broadcast company's nightly news, or read that newspaper's article, we would have all been getting the same message, the same information. Now we are all getting very personalized, atomized feeds on our cell phones or tablets. We're seeing individual messages and personalized content potentially around quite specific things that are very different, maybe even to the person sitting right next to us at home on the couch or on the bus in the morning. And so that has, I think, helped lead to polarization, a sense of isolation, aloneness, and that has then led to this pushback of wanting to be together, wanting to come together, wanting to experience the same things. And that has really helped build up the importance of sports and sports rights for legacy TV and CTV both. I think, the important thing here for this group is the extent to which, there are already ties across, especially digital out of home and CTV. What else can be done within and around the world of sponsorship in sports? Because that is increasingly where brands are looking to find consumers in this state of collective effervescence, where we are experiencing the same thing together, rooting for the same national team or local team. And we are talking about really big numbers here. So this is a look at sort of the top 13 or so global sporting events. All of the top 10, each individually netted more than $100 million in global ad revenue. For the US alone, the Olympics netted NBCU $1.2 billion in revenue for Tokyo. That figure is likely going to be even larger this year. So huge opportunity, I think increasingly important for brands looking at finding those big tentpole moments and cultural moments to get in front of consumers and be a part of that energy. Now, everything that we've talked about ultimately is going to depend more and more on the technology enabler that is AI. Can't have any conversation nowadays in our industry without talking about AI. And I would argue that that's because perhaps in no other industry is AI already more pervasive and more directly impactful on revenue than it is in advertising. I keep throwing this challenge out there. No one yet has told me I'm wrong or come up with another industry where it's even more integrated. So if you find one, let me know. But in the meantime, I'm going to continue with that point of view. And by our estimates, this year, nearly 70%, if we're rounding up 70% of total ad revenue will be AI enabled or informed in some way. I'm going to break that down because I'm going to explain exactly what we're talking about. We are taking a fairly broad view of AI in this case. We're not just talking about generative AI tools like chatbots and OpenAI. We're talking about the full tool suite, including things like natural language processing that is used in search. We're talking about optimization algorithms and recommendation algorithms like those on TikTok, and generally just machine learning, both unsupervised and supervised. So these tools have really been at play and in use within advertising over the last decade plus. It's been happening primarily within individual digital platforms, within Google, within Meta, within some of the other DSPs and SSPs within Amazon. And that really has led to sort of that, and the shift into digital led us up to this 70% number where we are today. Makes sense if we also think about globally, digital is more than just over 70% of total advertising, and most digital is going to be using one or more of these tools. Where we're looking at going over the next 5 years now is increasingly implying this technology to pre-planning allocation, cross-platform optimization. That's going to have the potential to pull in additional channels. So not just optimizing within Google for Google or within Meta for Google or within Meta for Meta, but using AI at the advertiser level, at the agency level, to look across and see, well, how much should we be spending on Google, but versus out of home or versus CTV or versus radio and print. And being able to look at that level is going to be increasingly important, increasingly large use case for AI. And one of the things we talked about in San Diego was the need for data to be present within these tools to be able to make those kinds of allocation decisions. So, making reach curves and other data on attribution available in order to supply these tools, in order to enable advertisers to make these decisions, potentially to increase the share of out of home within their budgets. So that's where we're headed over the next 5 years, again, within the sort of more process piece and enabling advertising revenue. Now, the other thing that let me go back just 1 second. The other thing that we talked about was increasing use of generative AI in content creation. So that's going to be something, maybe less so for sort of static or traditional out of home, but potentially for digital out of home is advertisers wanting to understand when they are adjacent to or within AI generated content. And I think I've been impressed in speaking with Steve and others in the industry around using AI to improve at least processes, if not the end creative, at least being able to mock up creative and improve that. So definitely more use cases for both, I think, traditional and digital out of home moving forward. So let's get into some numbers. We're going to look globally and then with a greater lens at the US as well. So again, 7.8% global advertising growth up to 990 billion. There has been so much volatility in both globally and the US over the last several years, in the ramp up to 2020, where we were seeing a lot of venture capital money flowing into advertising, small business money flowing into these digital platforms. And then, of course, the pandemic itself, the recovery with the shift into e-commerce, with the shift into retail media, now into sort of a normalization period where we're actually expecting ad revenue to kind of exist again below global GDP growth. So we were in a period where advertising was growing faster than GDP. I think we're now getting back to a place where advertising is more likely to grow below GDP, especially at a global level, and especially as interest rates stay high and it's maybe more difficult for especially, say, venture-funded companies to be plowing a bunch of money into advertising. But we'll see where we get to over the next 5 years. Very quickly on global channel growth, we'll also see this chart from a US perspective. You can see here out of home growing very, very well. And part of that, particularly off the back of revisions we've made to China. So we had been using or weighting more heavily our access to public companies in China. We recently revised our out-of-home expectations to look at the public out-of-home companies in China with a lower weighting. And that has led to dramatically different expectations for both where out-of-home exists now globally and also where it's going to go over the next 5 years. So we actually believe that out-of-home in China recovered much more quickly from the COVID lockdowns than we had previously thought. And then it will continue growing quite well in that market, especially in second and third tier cities. And I think potential for that across the US as well. Second and third tier cities, alongside the rollout of digital out of home, especially. But again, digital out of home, if we're going to look at any of the global numbers, really, really dependent on China, where that one market is 54.6 of global digital out of home in 2024. So within the United States, this is now the channel split for the United States. Again, expecting 5.8% in 2024. 4.9% in 2025, and these figures are all excluding, on this slide, excluding the impact of US political advertising. Within the US, retail media is going to be the fastest growing of the segments at 22%. That's in line with what we've seen already this year out of the largest sellers of retail media like Amazon and Walmart, both of those at plus 20% revenue growth in the first quarter. Expecting for that to be pretty strong still through the back half of the year, even as we lap the fourth quarter of this year. It's going to add, $8.6 billion in this year versus last year, and reach a total that is close to $50 billion. Now, that also includes last mile delivery services like Uber and DoorDash, and then alongside all of the retailers as well. We don't include in that number things like Booking and Expedia and United Airlines that are selling services rather than goods. CTV is the next fastest growing. Lots happening in that space, obviously. Still some acquisition mergers. We have Walmart's acquisition of Vizio, which I think is really smart in terms of enabling them to combine that video inventory with in-store attribution and create a more holistic picture and opportunity for advertisers. But it's still still a lot of players across both sort of the tech side of things, LG and Samsung, and then the sort of legacy players like Paramount and NBC with Peacock, and then the new digital-only sort of starters, so Netflix, Amazon, companies like that, all in the space and all driving that innovation and growth over the next couple of years. Out of home this year, we actually have a little bit lower than the first half results. Now, I think some of that is, again, because we are excluding political revenue. I was just having a chat with Steve in preparation for this, where we may adjust some of our expectations for political, and that would bring this number up a bit in our end of year expectations. And again, not including cinema or out of home numbers, but expecting a return to very robust sort of high single digit numbers next year at 6.9% as well. Then you get down into print and linear TV in pretty significant decline into this year and next year, as we see cord cutting and the shift to streaming, especially impacting linear TV. Now, US out of home, these are our estimates for both traditional and digital. This chart I have included political, and you can see there, including political, our growth figure comes up to 5.8%. So again, may just be that we are looking at recalibrating to some extent how much revenue is flowing into political advertising within the US. Digital growth of 5.2. Oh, sorry, that was the traditional out-of-home growth in 2024. Digital at 5.2%. And you can see here, digital really barely skipped a beat in 2020, and then has really come back strong and is going to be the source of growth out over the next 5 years. So, traditional out-of-home, beyond recovery pretty much at this point, and continuing to grow above 2019 levels. But really the most of the growth coming from the digital side of things. Now, US retail media, I'm going to touch on a couple of the other fastest growing channels. Again, I think, my job hopefully is to bring a bit of a wider perspective on multiple categories and channels of advertising beyond just out of home. It's I think important to speak to a couple of the fastest growing ones, including retail media. So again, 22% expected this year. Really, the majority of that is Amazon and then Walmart. And then we have sort of a second tier set of companies that include the grocery companies and last mile delivery companies, include things like Instacart, Target, Kroger, and Uber. And then you get into a sort of vast long tail of smaller and more niche players, whether that be something like an Ulta Beauty, a Nordstrom, Macy's. Those then make up the rest of that, nearly $50 billion number for 2024. We do expect growth, again, sort of to normalize over the next 5 years. I do think there is going to be continued growth as these companies look to leverage their data, not just on their sites and on their platforms, but increasingly off-site, tied to things like in-store audio and video, and then increasingly CTV as well, either through partnerships, whether that be something like Walmart and NBCU, or through owned properties within Amazon and Walmart. So certainly increasing uses of data, but applied to other channels. And speaking of streaming TV, this is our view of TV for the US, both traditional in the dark blue and streaming in the light blue. And we actually expect streaming TV to surpass traditional in 2029 in terms of ad revenue. That'll come after we've already seen the shift of consumption, so average weekly hours shifting to CTV from live and time shifted. That'll actually happen in 2026, but partially as a function of the difference in ad pod times. You get roughly 12 minutes per hour on linear TV, 4 to 5 minutes per hour on CTV. So the transition of advertising revenue tied to each of those channels a little bit slower in making the transition to majority. So seeing that in 2029, the channel as a whole is going to be roughly flat over the next 5 years, again, with all growth coming from digital channels. And just to note that there are now multiple $1 billion plus streaming media owners in the US, gaining time and attention from the largest brand advertisers. So lots more to come in this space, potentially some additional consolidation as well, because it remains a little bit fragmented, but also certainly ongoing strength among those that are plowing the most into content as well. So the biggest content spenders, including YouTube, in fact, Disney, Comcast, Amazon, Netflix, Paramount, and Warner Brothers. I think we're a little ahead of schedule. Actually, I had my full cup of coffee this morning. Very, very fast talker.
It's all,
I think
it's
we're
all
gonna
great.
pause there and get into some questions. Perhaps leave some more time for questions from the group as well.
Yeah. Thanks, Kate. That was such a great overview. And obviously, we have a lot to be excited about and look forward to, not only for the bounce this year, but it seems like, there's even more promise for next year. We got a lot of really great questions in during the registration process, but Kate, I'm going to ask you one that just came in. And I have, I think, my own perspective on this, but the question was, looking forward to 2025, since that growth number for out of home is going to be, significantly higher, kind of what do you see as driving that?
Yeah, I mean, I think there's increasing, as we go through this year, it feels like increasing certainty about the economic position. I think we're expecting, we're seeing good numbers now on inflation. We are expecting to see the first rate cuts now from the Fed within the next 1 to 3 months, maybe. I mean, I was definitely in the camp in December last year that rates were going to stay a lot higher than higher for longer. I was not in the March camp. I thought the earliest would come maybe July at the earliest. So that's been borne out. But actually the US economy has been even more resilient than I had thought. But I think we are seeing it weigh on business investment, on mortgages and auto loans, and increasingly on the American consumer. So I think as we get into the back half of this year, where inflation continues to cool, we start seeing the first of those rate cuts, that businesses in particular will feel better about spending into the start of next year.
Great, terrific. I'm going to take this next one. The question was, what out-of-home categories saw the most growth year over year? And I'm going to reference our most recent period of reporting, which was Q1 2024. And total out-of-home grew 6.8%. While digital out-of-home grew 10.3%, and it accounted for almost a third of our sales in Q1 2024. Looking at out-of-home specific categories, transit was the fastest growing of the 4 categories. It grew almost 19% in Q1, and it was followed in growth by place-based at almost 13%. Not sure if the question was asked specifically about out-of-home categories or product categories, so I'm going to cover those too. On the product category side, looking at the top 10 categories that spent in out-of-home in Q1 2024, the greatest growth among those was online and mobile travel services, which grew 137%, legal services, which grew 19%, and then cable and television, which is very entertainment driven in terms of, oriented towards programming, that grew 18%. So that's a recap of those. And then, Kate, here's another one for you, please. How are the unfolding lower corporate earnings and recent retail layoffs impacting ad budgets or marketing campaigns?
Yeah, I think, I've been encouraged by earnings we heard about, 2023 full year and Q1. I think it's interesting that we've heard a few more out-of-home companies talking about CPG as well as an opportunity, or maybe even a little bit of potential increases from CPG. That group, I think, has been very bullish around the opportunity to use marketing and brand investment to continue to drive growth, even off the back of this transition for them from really pricing driving revenue growth into now needing for revenue or organic growth to come from volume. And so I'm interested in that. I think, companies like the Coca-Cola company, which does a lot around innovative out of home, I think is a good benchmark. They won the most creative company at Cannes Lion this year. So I see that as potentially being something that other brands and especially other CPG brands look at in terms of inspiration for the coming year and how they can think about investment beyond sort of digital and traditional TV. But we'll see. Start of earnings week now, so we had Pepsi already. They're talking about surgically optimized advertising spend. So again, I think there the opportunity, you can see why so much of the growth has been in digital out of home already. But really companies looking at walking that fine balance between effectiveness and optimization, which they feel they can get from the more digitally focused channels, alongside really pushing brand messaging, brand innovation, reach and engagement. And so the channels I think that do the best at marrying those two things are going to be well placed.
Yeah, and I think to that point, that's one of out of home's, I think, greatest strength is our impact throughout the consumer funnel. Especially the last decade, there's been able to do a lot of work, and there are a lot of solutions out there now that really show how effective out of home is in the lower level of the funnel too. So yeah, that's great news for us. The next question, I'm going to take this one. Is digital out of home gaining or losing market share relative to other out of home channels, and how much? So, to what we saw in your presentation about digital advertising overall is the same in our industry, of course, and it is, as we saw in your specific slide about digital out of home, it's our industry's biggest growth driver. So last year, digital out of home grew 10%, and that was compared to 2.1% growth for total out of home. And then just to reiterate the numbers I already shared earlier, for Q1 2024, digital out of home was up 10.3% for the quarter compared to a year ago, while total out of home grew 6.8%. So again, it is our biggest driver. Will continue to be in the future. Kate, another one for you. Are there significant forecast variations by regions of the U.S.? And what are the strongest and weakest advertiser segments? So really, I guess two questions there.
Yeah, we tend not to forecast on a regional basis. I know, a lot of activity tends to be based on the largest DMAs. I'd certainly listen when you guys talk about regions. Being based in San Francisco, I kept hearing San Francisco listed as a drag on growth within out of home over the last year or so. We don't release it in terms of this year, next year. We do look very closely at an advertiser category perspective. So for us, we talk a lot about CPG. It is the largest contributor to global ad revenue. We figure roughly 20%, nearly 20% just from CPG. And then the next category we look at, which you probably won't hear other places, is one that we call digital endemics. And that's really internet-based businesses or online-born businesses, they're sometimes called, which have a different, often makeup and profile than their traditional counterparts. So we would consider Amazon a digital endemic, whereas a Nordstrom and a Walmart would be a retail advertiser. Booking and Expedia are digital endemics. Marriott and United are in travel, right? So it's that breakdown difference. The online dating apps are part of our digital endemic group. A lot of D2C services and consumer goods companies, they make up 10% by our estimates of global advertising revenue. So huge group. It includes things like Google and Meta and Amazon and their spending, Amazon being one of the largest in the US anyway, buyers of advertising, as well as being a major recipient of it. So these are companies that we watch very, very closely, and they tend to spend a higher portion of their revenue on advertising than other advertiser categories. So this is above 10%. The last I think we had was 12% plus for those companies, excluding Google, Meta, and Amazon. And so that's a much higher percentage than, say, CPG at 5%. Technology and telecoms are below 2% of revenue on advertising. And so they're a good bellwether, basically, when we're looking at some of the trends in growth. We have seen that share of revenue come down over the last several years as interest rates were hiked, right? It was harder to get new capital on board. There was less appetite from shareholders or venture companies to spend aggressively on growth. So I think as we come out of this year, again, as we see interest rates start to fall and inflation start to come down, that we'll see, I think, growth across a couple of those categories. Auto as well, I think as interest rates come down and loans become more affordable, hopeful that that group increases. And then the other one I would say is technology, which I think has been called out as a source of weakness, especially amongst all the agency groups over the past couple of years. You know, we went through the pandemic period where everyone went out and bought laptops and tablets and computers and appliances all together, all at the same time. And we've been in this lull of sort of, you know, the update cycle, which had been staggered, then started to go all together. And so I think we're now at this 3 years on stage where we're going to start to see those upgrade cycles kick in. We're going to start to see companies using AI as a means to get people to buy new technology. And I'm assuming that there's going to be, you know, a good amount of advertising spend to support that growth as well.
Yeah, certainly that. I think that's Apple's game plan, right?
Yeah.
Yeah, so interesting.
Apple and Microsoft. There's a button now. There's a button for AI.
Yeah.
A key.
So for really I think pretty much the last decade, if you look at our top 100 advertisers, I mean, very consistently 20 to 25% of that group has been both tech and direct-to-consumer brands. So yeah, but also to your point about CPG specifically, I think there's a lot of upside and potential for our industry there. That's a segment that we've garnered less ad spend in historically. But just to kind of tease with everybody a little bit, I'm going to give away a little bit of the story here. We did some work with benchmarking last year that showed how out-of-home is really under-allocated, specifically in the CPG food category. And we've gone back and done, we came up with what media plan should be adjusted to in total, including out-of-home, to optimize the overall plan. And across those 3 categories that we studied, automotive, CPG food, and retail grocery, it showed that out-of-home is being under-allocated, that to get a total optimization of the overall plan, out-of-home should be increased. But what we've done with the second phase of the study is we've gone back and looked at incremental steps to get to that full optimization. And the really great news is that brands can really take a huge leap forward in that total optimization, even with some pretty minor adjustments in terms of increases in out-of-home. And that's certainly true in the CPG food category. So hopefully we'll continue to up our game there, because I think there is a lot of opportunity for us.
Pepsi just last week talked about amplifying Frito-Lay in the US. So there you go. Go get them.
All right, everybody on the call, there you go. Great tip from Kate. I'm going to go ahead and take this next one too. Are there any available transit-specific metrics or forecasts available? As I mentioned earlier, in Q1 2024, it was the fastest growing out-of-home category, grew almost 19%. Again, a lot of that is still recovery from the pandemic, but it certainly is coming back strong, and that's great to see. Kind of on a separate side of the equation in terms of consumer engagement with transit, we see air travel in the US was up 7% in Q1 versus a year ago. Overall transit ridership was up 8% in Q1 versus a year ago. And then bus ridership was actually up even higher. It was up 10% in Q1 versus a year ago.
The July 4th weekend, I think, was the peak air
yeah.
travel. Yeah, sorry, am I stealing your next stat? Us data people all look at the same stuff.
So anyway, yeah. So, really promising activity and trends there in the transit segment. And hopefully we'll continue to see that, continue. Let's see, Kate, a few more here. I think one more for you and one more for me. And so this next one to you, please. What emerging channels in digital out of home do you think are generating the most impact right now?
And so by channels within digital out of home, we think that we're talking about.
I'm gonna guess that's like, retail media and so on. Yeah,
Okay.
like segments
Um,
like that,
yeah, so I mean we count retail media separately. That's all advertising revenue accruing to retailers specifically. So different than say a billboard in the vicinity of a store. Although I think there are probably interesting ways for those to be combined. But maybe I'll just kind of touch back to what we see as the fastest growing channels generally, right? Again, retail media, CTV. You can see again that increasing interest by advertisers to be able to better attribute their sales to their media spend. But I will say the counter to that, I think, is really there are brands, and again, especially in the CPG space, where that idea of how brands grow, the need to reach incremental buyers, new buyers, is still very, very important. And as we see things like the reach potential on linear TV continue to erode, they are going to be looking at additional opportunities, right? And so I think that's where in meetings with clients, we end up talking about things like out of home, like audio, that have been shown to be very effective and may be sort of underinvested on a plan as another way of getting that mass reach that isn't reliant on traditional TV. So I would say that's another area where I think there's still opportunity. And again, increasingly associated with things like big cultural movements and sports in particular.
Yeah. And I think just to kind of supplement that, things like augmented reality that continues to, really offer unique ways for our medium to engage consumers. And this year's Obie overall Platinum Award winner, that featured augmented reality with Space Invaders. So that was an incredible campaign. So I think those technology solutions and innovation are going to continue to help drive that. The question asks more about emerging channels, but I'm going to throw this in anyway. Where the lion's share of digital is coming, of course, is through the billboard segment, because that's 73% of our total business. So that is where the lion's share of it still comes in. But yeah, it'll be interesting to see how some of that emerging business continues to shift that overall digital out of home equation. So the last question that we have was, what is the correlation between online advertising and billboards in today's market with Gen Z and millennials? And I'm taking this one, Kate. So all OAAA out of home research studies, we examine demographic segment impact, and that it does include Gen Z and millennials. And what the data consistently shows is that out of home over indexes with both of those segments across almost every measure. And that includes online activation. And I'm going to give this as an example. Our recent Harris Poll digital out of home study found that digital out of home ads had recently produced a mobile device action among almost 3/4 of adult consumers. While the mobile action generation number for Gen Z actually jumped from 3/4 to 85%, and for millennials up to 82%. And that's just one example. But out of home overall just makes out of home advertising work harder and makes it more effective because of all the amplification and activation that out of home provides and drives. So, we're a great marriage for those two channels.
Yeah, I do think, I mean, something to keep an eye on and something that we're, I think seeing more in the news and talking to people about is some of this pushback on living lives online, right? And being more out in the world. And I think both young people and people from all generations feeling that, right? The idea of banning phones in schools, for instance. And this has been something we're seeing in China as well, where they're actually sort of using online platforms to push people to go do things in real life. So I think in as much as that is a sort of underlying trend that is, again, potential for more IRL use cases for advertising, I think is interesting moving forward.
Yeah, and we actually had one additional question pop in, and it was related to digital out-of-home growth, and it's about the role of programmatic plays in that growth. And the question, that was the first one, and then number two, is there a vast difference in U.S. versus global programmatic? And I'm gonna answer, and you can supplement. I would say that right now we don't have a really firm way to measure the overall impact of programmatic and digital, but from the data that we see, certainly it plays an important role, and it's helping drive that digital out-of-home growth right now. But I think the most important factor is the promise and potential it offers. And I'm just going to use political as an example. The way so much political business is placed right now is those political shops go right into digital platforms, and they place almost all their media programmatically. And so anything that we can do to make digital out of home, part of those systems, and make it easier and reduce any possible friction, et cetera, that just opens the playing field for us even wider. And I think that in some other countries that they may be a little bit ahead of where we are with programmatic digital out of home.
I'd say, yes, we hear about it, especially within like Austria and Germany, in that sort of DACH region. They, I think, have done a really good job of combining the out-of-home providers with agencies and advertisers, both on education, the pipes, the data available. So I think in my reading and looking at the world, I'd say those two are some of the more advanced within the programmatic space within out-of-home.
Yeah, great. Well, Kate, thank you so much. This has been terrific. We really appreciate the excellent insights. And also, again, thank you so much for the terrific presentation that you did at our conference earlier this spring. I would like to remind everybody that the full recording of today's webinar will be available on our site later today, along with the summary of the presentation. And then we hope you'll also take a moment, please, to give us feedback on what you thought of today's presentation to help inform our future programming. So thanks for everyone for joining us today. Enjoy the rest of your day. Have a wonderful afternoon. Bye.
Thanks.